So let's talk about step 3, intercompany transactions. So when we're consolidating, because we're treating it as two companies, the parent and the sub, as one entity in the consolidated statements, we need to eliminate all those intercompany transactions. What we're looking to do is see what does the balance sheet and the income statement look like if you are treating it all as one organization and only recording entries into the statements to outside parties. So we want to eliminate dividends from the subsidiary. So this is going to affect our income statement and our retained earnings. We're going to eliminate interest or management fees paid between the companies. So again, this is going to affect our income statement. And we want to eliminate any intercompany payables or receivables from management fees or interest. And that's going to affect our balance sheet. Think about a management fee. It's income to one party and an expense to the other. So really, your bottom line isn't actually changing. But because we're consolidating, our revenues and our expenses would both be overstated. So same with intercompany payables and receivables. The payable is going to be the exact same amount of the receivable. So it's not actually changing your net assets, but it will affect your ratios when you're looking at the consolidated statements because your payables and your receivables would be overstated. So we need to go ahead and we need to eliminate these entries. So these are the entries that would be covered in this chapter. In chapter 6, we're going to talk more about intercompany profits, so selling of inventory between the different parties. But we will get there. We're not covering that yet. So let's just do a quick little example. Let's assume that we've got 80% ownership and our sub pays $30,000 in dividends, and we need to eliminate those dividends. So we've got $30,000 in total dividends, but we only own 80%. So we want to debit, because we want to eliminate the dividend income from the parent. So how much are we going to eliminate? 30,000 times that 80%, so 24,000. How much did the sub record as dividends? Well, they recorded 30,000, so we need to go ahead and we need to get rid of that. So we're going to credit the dividends for that 30,000. I'm just going to put 30K. I'm running out of room here. So what is our balancing entry? We're missing a debit of 6,000. Who did that other 6,000 go to? It went to our non-controlling interest, right? So we're going to go ahead and we're going to debit our BNCI for 6,000. And so that's what that kind of entry would look like. So let's go ahead and put step 3 into action using example 2. So we've done step 1, we've done step 2. We're now going to do step 3. Eliminate our intercompany transactions. So if we read our dialogue up here, we can see that during year 6, Little paid dividends of $13,500. So we know that we need to get rid of that $13,500. So on the parent side, what is Big recording? Big is recording some investment income. So we need to take that off of the income statement. So we're going to debit investment income. And what percentage does Big own of Little? They own 80% here. So they're getting 80% of that $13,500. So $10,800 is what we're going to be debiting because that's the amount that they recorded as income on their income statement. Now, Little has recorded dividends of $13,500. So we know we need to go ahead and we need to credit dividends of $13,500. And everybody realizing that this is an equity account here. So our journal entry doesn't quite balance here. So what is our balancing entry? Our balancing entry is to BNCI, our non-controlling interest, the portion of the dividend that they received. So we're going to debit BNCI for $2,700. And so that is that 20% that's going to the non-controlling interest. Now remembering, BNCI is also an equity account. So what are we doing here? We're decreasing, by eliminating that dividend, we're decreasing the amount of BNCI, non-controlling interest, on the balance sheet that is attributable to that non-controlling interest. So what color do we need to highlight all these so we know where to put them when we're consolidating in step 7? So our investment income is an income statement item, so we're going to highlight this one in yellow. BNCI, we know, is a balance sheet account, so we're going to highlight this one in blue so we know it hits the balance sheet. And dividends, we know, are on the statement of retained earnings, so we're going to color this one in pink. And so in this example, this is the only intercompany transaction, so this is the only one we need to capture.